Right now, Beyond Meat, ticker BYND, is trading live at $1.65, and it is in absolute free fall, down a catastrophic 10.5% on the day as of 11 a.m. Eastern. The stock is getting hammered on truly massive volume, with nearly 72 million shares having already traded. To see a stock lose over a tenth of its value in a couple of hours is a violent move, and it's not a mystery. This isn't a dip. This is a capitulation. The immediate expectation for anyone who remembers the hype around this company is that this must be a mistake, a massive overreaction. But the reality is that this is the market finally and painfully pricing in the fact that the entire plant-based meat narrative, the one that took this stock to over $230 a share, is completely broken. This isn't a growth story. This is a story about survival, and the market is betting it won't make it. We all remember the common ground. Just a few years ago, Beyond Meat was the investment. It was seen as the Tesla stock of food. It was the future. If you were getting into online investing, opening an account on the Robinhood app or SoFi Invest, buying BYND was the clean, ESG-friendly, high-growth play. You weren't just making a financial decision, you were making an ethical one. The expectation was that this company would fundamentally disrupt a multi-trillion-dollar global industry, and its stock price reflected that. It was talked about in the same breath as a high-growth tech stock like Nvidia stock. But the reality that has set in is a brutal counter-narrative. The reality is that consumers have not just cooled on the category, they seem to be actively rejecting it. The product is expensive, it's perceived as ultra-processed, and the crushing competition from cheaper private label store brands has eaten it alive. This is no longer a premium, disruptive product. It's a niche, high-priced item that has lost its sizzle, and the company is burning cash at a rate that is terrifying investors. Let's look at what is happening right now, because this stock story has become a case study in financial distress. The entire market is holding its breath for the company's Q3 earnings, which are set to be reported on November 4th. But the company already gave a preliminary release on October 24th, and it was a disaster. They are guiding for revenue of about $70 million, which is another steep decline from last year. Worse, they are guiding for a gross margin of just 10% to 11%. This is a company that has no path to profitability. Its operating expenses are expected to be around $42 million. This isn't a company just losing a little bit, it's incinerating cash every single quarter. This is why you don't see this in a stable, long-term portfolio like Schwab Intelligent Portfolios or in a collection of Fidelity mutual funds. This is the opposite of the kind of stable, cash flow positive business like Apple stock that anchors Fidelity Wealth Management. This is a speculative gamble, plain and simple, and the house is winning. The massive drop we are seeing today is the market's delayed reaction and continued panic over the company's debt situation. This is the real story that many new to self-investing might miss. This isn't just about bad burger sales. At the end of September, Beyond Meat launched a desperate exchange offer to deal with over $1.1 billion in convertible notes that were due in 2027. This was debt they had zero ability to repay. The plan? Swap that debt for new, higher interest 7% notes due in 2030, and, here's the killer, a massive, almost unbelievable issuance of new stock. On October 13th, the company announced the results. They were issuing over 316 million new shares. To put that in perspective, the company's entire share count was only around 64 million. They increased their share count by nearly 5 times. This was a dilution event of such epic proportions that it effectively wiped out existing shareholders. The stock collapsed 47% on that day alone. This is what financial distress looks like. They avoided a 2027 bankruptcy by completely sacrificing their equity. So when you see this stock lurching around, it's not because of a new partnership. It's because this stock has become a meme stock in reverse. It's a battleground. The short interest on this stock has been astronomically high, with some sources like Ortex reporting it at over 100% of the float just last week. This means traders using sophisticated interactive brokers accounts are betting heavily that this stock is going to zero. The recent bizarre 600% surge from its 0.52 low was a classic violent short squeeze, where all those shorts were forced to buy back shares, creating a temporary artificial spike. That spike was triggered by news that they were expanding their Walmart distribution. But a short squeeze is not a fundamental turnaround. It's a technical dislocation. And now, as you can see from today's 10% crash, that squeeze is over, and reality is setting back in. This is not a stock for an investment, but a high-risk trade. Let's be clear about what this company does. BYND Meat develops and sells plant-based meat alternatives, burgers, sausages, ground meat. The business model was to sell these products at a premium price through both retail channels, like grocery stores, and food service channels, like restaurants, think McDonald's, KFC, Starbucks. The expectation was that as volumes grow, costs would come down, and they would be profitable. The reality is that volumes are falling. Their Q2 report was a horror show. U.S. retail sales fell 26.7%. U.S. food service, which was supposed to be the big growth driver, was up a tiny bit, but is still a small part of the business. International sales are also falling. People are just not buying the product. The company has blamed everything from misperceptions about health to consumer fatigue. But the reason is simple. It's expensive, and consumers have moved on. This brings us to the financial health, and it's grim. The company's Altman Z-score, a metric used to predict bankruptcy, is deep in the distress zone, implying a high risk of insolvency in the next 2 years. The only reason they are not bankrupt now is because of that debt-for-equity swap. But all they did was buy time. They still have to service their new 7% interest debt, and they are still burning cash from operations. Their Q2 net loss was $29 million, and that was after a massive cost-cutting plan. They are trying to get to EBITDA break-even, but they are nowhere close. This isn't a stock for your Fidelity IRA. This is a stock that requires constant monitoring, the kind of thing you'd only watch on the Fidelity mobile app or a dedicated Fidelity trading platform, because you're actively trading the volatility, not investing in the future. This is a good moment to ask a very direct question, and I want you to be honest. Comment below with the last time you actually bought a BYND Meat product. The answers to that question will tell you more about this company's future than any analyst report. So, what is the future outlook? This is a company at a crossroads. The expectation from the bulls, if any are left, is that the recent Walmart and Erewhon news, combined with new, cleaner label products, will finally stop the bleeding. They hope the massive cost-cutting will align with the new, lower revenue, and the company can survive as a smaller niche business. The reality, which the market is pricing in today, is far darker. The debt swap was not a solution. It was a symptom of a terminal illness. The massive dilution means that even if the company does survive, the upside for any new shareholder is incredibly limited. The analyst community is in agreement. The consensus rating is a moderate sell, with 5 strong sell ratings. TD Cowen recently set a price target of 0.80. That's not an investment. That's a warning. This is not the kind of holding you put into an intelligent portfolio for long-term growth. It's what people buy on Robinhood stock trading, hoping for a lotto ticket, without realizing the ticket has already been torn in half. In summary, This 10.5% collapse in Beyond Meat stock to $1.65 is not an anomaly. It is the painful, logical continuation of a dream disintegrating. The expectation was a food revolution that would mint millionaires and save the planet. The reality is a company that has been fundamentally rejected by its target customer, is buried in debt, and just diluted its shareholders into oblivion. This stock is a case study in what a great story collides with a terrible balance sheet and falling demand. The squeeze is over, the hype is gone, and what's left is a company fighting for its life. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. Bank. If you found this helpful, don't forget to like, comment,